Good morning, everyone. I'm going to wait a few minutes as we have a large crowd today before we get started. Give it a little time for everyone to join. And I'm going to go ahead and get started as we get more people registering. I'll go through some of the requirements here along the way. So again, good morning. Thank you all for attending today's webinar. What you need to know about buying or selling a business in a COVID economy. I'm Larry Heller of Heller Wealth Management. We provide personal financial planning and investment strategies to help create financial resiliency. As we emerge from COVID, we have seen more activity from owners looking to sell and more people looking to buy a business. So what do you need to know? Well, I'm very happy that we have two experts that are here to help. Lee Schwartz of Schwartz Ettenger, a corporate attorney specializing in mergers and acquisitions, and Albert Hakim of Kensington Company, an entrepreneur and certified mergers and acquisition advisor who specializes in business transactions. I will be asking both of our experts questions that can help you. We also welcome your questions. If you would like to ask a question, please type in the question in the Q&A box on the bottom of your screen. We will try to have our experts answer all of your questions, but we do have 100 attendees for today's webinar, and if we are unable to get to your question, I will make sure we will send a response to you via email. We are going to do two poll questions during today's webinar, so I'm going to start the first one right now. So first polling question is, what do you hope to learn from today's webinar? Information about selling a business, information about buying a business, or information to help advise your clients about buying or selling a business? We're going to cover both topics today, just trying to see a little bit if there is one side more than the other. While this poll is going on, why don't we get started with our first question? Albert, how has COVID changed the buying and selling in today's environment?
Great. Thank you, Larry. And thank you to everyone who's attending this morning. Let me jump right in. So COVID has dramatically changed the way we do business. And I believe we still don't even understand the full ramifications of that change. Let me ask you to just suspend what you think about how COVID changed business and consider the following. Think about Long Island and what happened on Long Island. Let's not focus on Manhattan because that's a different set of issues there. So I know that myself, along with many, thought we'd be seeing tons of foreclosures, many business closings, and frankly, the end of the world. And the reality is that many businesses never stopped. Some actually did better. And by and large, we came out of it pretty okay, not minimizing those sectors that were devastated and the pain that was endured. Believe me, I know and I feel it. But when you look at things, those restaurants that, were closed for a while, they're back. So Larry, I want to get to your question. What I've tried to do as it relates to buying and selling is to synthesize this to 3 specific topics that I think are germane, as well as what I call the reset button. So number 1 is the pivot. Every business pivoted. Some pivoted better than others, some not so much, but every business had to adapt. And we're going to get into that a little bit as we go further. Number 2, a subject near and dear, hopefully to your heart, Larry, and CPAs out there, balance sheets. Balance sheets are now stronger. I'm going to explain, whoa, sorry about that. I'm going to explain why, because it leads me to number 3. Number 3 is the amount of money that the government invested in our economy. They poured a ton of money into the economy, and you know what they did with it? They gave it to us. So many businesses who were suffering from the typical burden of debt and the high cost of debt to operate, especially inventory-based businesses, really benefited in such a significant way. And let me share a real-life example to crystallize and really drive this home. We have a luxury goods importer. They import and distribute luxury items for the home. Their primary business is wholesale. They do a little bit of e-commerce. We're in a contract to close in April of 2020. What happens? COVID comes along and shuts down the middle of March. And by the end of April, when they're scheduled to close, sales are off by 80%. Not an insignificant amount, 80%. So the buyer can't conclude a transaction. Lee, I'm sure you've seen this.
Yes.
The other thing that's important to understand is that this sale was approximately $500,000, and the owner has about $400,000 in debt. In fact, it's one of the reasons he's selling. He's been operating the business for 30 years. It's cumbersome to operate, to get the inventory from overseas and have to carry it and have to borrow the money until they get paid by the retailers who are dragging them out 60, 90 days. Anyway, long story short, if he concluded that sale, he doesn't keep very much of his proceeds. And it didn't matter. After 30 years, the seller is ready to get out. So COVID comes along, and how is this seller going to sustain an 80% reduction in sales and be able to manage that debt? The answer is he's not. Now, it's not an older gentleman, not a young man, but not comfortable necessarily with the world of e-commerce and social media and all of the marketing that relates to that. So he hires an expensive consultancy, and they get him a better presence on the internet. And what do you think happens? Little by little, his internet sales start to tick up. And those sales are higher margin sales than the sales to the wholesalers, which are not buying because stores are closed, retail is shut down. The other set of circumstances that happens is he takes advantage of the EIDL and the PPP loans. And those loans come in, some are forgiven, some are long-term debt at a very low interest rate, as you know, and he swaps out his cumbersome, some of that debt was 20% interest for this new consolidated longer-term debt, eliminates the short-term for the long-term. So what do you think happens, Larry? Lowers his cost of operations, increases his margins. What's the result?
Higher profits.
Higher profits, higher profits. So this company is now on the climb. And fast forward to today, we're in a contract to close in a couple of weeks at a higher valuation than we had before COVID. And more importantly, the seller is keeping much more of those proceeds because he restructured that debt. That's an example how COVID really benefited this particular seller. The flip side is not so rosy. $1 million gym couldn't sustain, had to sell for $100,000 just to get out of the lease. And the seller was happy to do so because he was able to save his house. The point for the listeners is this. It is both equally a seller's market and a buyer's market. And this is what's unique about this moment in time. I would dare say we are in a a moment in time which I don't know that can ever be replicated. Low interest rates are enabling higher valuations. The money that's in the market are enabling better balance sheets for these businesses. So we have stronger businesses coming to the market, and we have businesses that could not sell before because of that weak balance sheets, which are now able to sell. On the buying side, you've got buyers who, while they might be spending more for a business, it actually costs them less because of the low cost of capital. So they're able to buy better businesses, and they're able to leverage in a much stronger way. What's coming down the pipeline that gives pause to all of this wonderful news is the fact that we do have tax increases on the horizon. We know that that interest rates are going to go up at some point. Nobody knows when, but we know that that's coming. But right now, it's the perfect storm for both sides. And I have to tell you, I don't think I've ever seen that. I want to close with one last point, and then I'll let Lee speak. When you think about pivoting and you think about buying a business and you look at how that business pivoted, I want to throw the word franchising out there. Why? Because you've got these franchise owners or these franchisors who have 500 franchisees, 1,000 franchisees, 2,000 franchisees, and all of those resources. They also had to pivot. They also had to figure out how to continue to operate and keep their franchisees in business. So in the marketplace are these wonderful kind of soup mix of pandemic hardened businesses for buyers to buy. With that, this is a complicated process, and we'll go through it more if we have time. And that's why you need your team around you to figure this out.
Great. Thanks, Albert. I'm going to share the results. It looks like we have a little bit more on the interest on the buying side. We do have some advisors on both, about 45% on the buying side. So just to give you both, Albert and Lee, some heads up on this.
Sure. Thanks, Larry.
So let's pivot over to Lee, and let's talk about what are the legal ramifications when it comes to both buying and selling a business.
Well, thank you, Larry. Thank you, everybody, for being here. Glad to be able to participate in this webinar. It's a great question, and certainly nothing's changed much with regard to COVID in the sense that, to me, the most important part of the initial stages of buying a business from a legal perspective is due diligence. And there's due diligence both on a buying side and on the selling side. With regard to the selling side, there's much more preparation involved. So if you're thinking about selling your business, it's something you want to start thinking about as far in advance as you can to prep your business to look as good as possible to a potential buyer. So really, with the COVID and the programs that were available that Albert had touched upon, specifically the PPP loans, as well as the other SBA loans that were available to business owners, that's kind of a new element to the due diligence process. As a seller, to try and reduce the complications associated with selling the business, you want to try and take those out of the equation. So certainly for the PPP loans, getting those forgiven prior to putting your business up for sale is helpful. Most sellers are going to require, most buyers are going to require that the PPP loans be forgiven before they actually close. A sale of the assets of the business, although not secured by the assets, is still a technical default under the PPP loans. In addition, there's a lot of businesses out there who took advantage of the SBA program, the EIDL loans that were available. Besides the grant that maxed out at $10,000, there was also the opportunity to get money at a low interest rate payable over a long period of time, payments of which still have not even started. So those are loans that some people are a little bit confused about. They are not forgivable. Although there is some talk that maybe the program will change and how things have changed over the last year and a half. There's certainly that possibility. But as of right now, those are not assumable loans and those are not forgivable loans. So as a seller, you want to try and deal with those by eliminating them either simultaneously with the closing, or certainly in the case of the PPP loans, prior to even putting the business up for sale. In addition to those things that are very much COVID specific, generally speaking, you want to also make your business look better to a buyer as a seller by having all your corporate records in order. And what I'm talking about is, if you're a corporation, you typically have a minute book. If you're an LLC, you don't, but you want to make sure that your corporate documents are in order, including ownership of the entities. Very often, if you have a closely held entity and there's been transfers amongst partners, transfers amongst family members, it's not always properly documented, although reflected on the tax returns. Because the first part of a transaction, typically, once there is an accepted offer, is a due diligence checklist that's given by the purchaser to the seller to provide all types of information. As a seller, you also want to make sure you have whatever agreements are appropriate for your business in place. You want to make sure that you have them signed. Very often, companies are a little lax with respect to having signed agreements with customers, with employees, suppliers. So you want to make sure everything is in order and pretty much accessible, and maybe in a file so that you can easily produce it. Another thing to keep in mind is, as part of the due diligence, if you have office space or retail space or whatever space you're operating from, if it's not owned by you, you typically have a lease agreement. You want to be familiar with what the terms of that lease are. A buyer is going to be interested in knowing not only the economic costs, but how much time is left on the term, whether or not there's a renewal option, how much security deposit is required, and the all-important question of whether or not there's any sort of personal guarantee, and if so, what type of guarantee it is. Certain businesses have legal requirements, licensing issues, permits that are required in order for them to operate. You want to make sure that those are all up to date and current, and that you have all the proper ones in place, because a buyer is going to want to make sure that when they come in, that they are able to operate, and they're going to want to know what the transferability of those licenses and or permits are, or whether they're going to have to start from scratch. Sales tax is another issue that often comes up with regard to the due diligence, and ensuring that you have properly filed and paid all the sales taxes is an important aspect of what a buyer is going to be interested in. Some other things to consider in connection with the due diligence process is, as a seller, you're going to want to do some due diligence on the buyer. You're going to want to make sure that they have the qualifications to obtain financing that may be necessary in connection with purchasing the business. And if you're dealing with franchises, you want to make sure that they're going to be approved by the franchise because the worst thing you want to do is spend time going through a due diligence process, going through contract negotiations, and then having somebody apply to a franchisor for approval and then not be approved. So those are certain things as a seller you want to be investigating. On both sides, you want to make sure that you have your team in place. Although not a legal issue, it's certainly an important one that I do want to point out, because once the ball starts rolling, it goes relatively quickly, or certainly most parties want it to go quickly. So you want to make sure you have a qualified attorney and probably an accountant involved to give guidance with respect to certain tax issues that may come up, and even if there's a question with regard to valuation. So you want to make sure with regard to the legal side that you have somebody who's experienced not only in business transactions, but maybe has some familiarity with the industry. Because as those of you out there who are in specific types of businesses, each business has its own nuances. I grew up actually in the car business. My father was a car dealer, and there's all kinds of different issues that come up in connection with selling a car dealership that doesn't come up in connection with selling some other type of franchise like Brugger's Bagels. So there's something called holdbacks. There's deals with demo cars, how you value the used cars. So you want to make sure that the attorney at least has some experience with the industry you're working in. And lastly, I would say that as a seller, you want to consider early on what you're going to be selling. The sale of a business is a complicated transaction, and you do not necessarily have to sell all the assets. It may be selling part of a business and not the entire business. Typically, excluded assets would also include things like accounts receivable, cash on hand and security deposits, as well as certain equipment. And the equipment that I commonly see excluded are like computers that people are using both for their business and their personal lives, cell phones people don't want to give up, as well as potentially automobiles that people are using both for personal and business use. So these are things to consider as you are getting ready to sell your business. One last point I want to make is in connection with a seller, ensuring that your employees cannot go out and compete with the buyer. Something a buyer is going to look for are restrictive covenant agreements. So if you have key employees, particularly in the managerial positions, you want to make sure that they are bound by restrictive covenant agreements of some sort, which generally include non-compete, non-solicitation, and confidentiality. So these are all things that every business should have, but certainly if you are contemplating a sale of your business, these should be in place and ensure that they're signed and likely to be enforceable. So these are things, again, that we've been dealing with for years with regard to due diligence. It's only some aspects of due diligence that have changed because of COVID, but I think that there's been a lot of activity because people who are on the cusp of deciding, well, should I stay or should I go, are saying, you know what, I've survived this, let me get out. And there's a lot of people coming in because they're doing, looking for changes in careers. They don't want to go into the city any longer. They want to have their own business. They want to be in control of their own destiny. So I think there's definitely opportunities for people to get out of the business. There's opportunities for people to get into the business. And for all the reasons that Albert was mentioning, I think that there's definitely significant opportunities there. You just have to be careful on which one you select.
Great. Thanks, Lee. So I'm guessing we have a lot of first-time buyers out there, and obviously the sellers out there want to maximize what they can get for their business. So Albert, why don't we discuss what are really the key considerations when you're both buying a business and selling a business that our audience should know about?
Yeah. So and I while Lee was speaking, I was paying attention, but I did see that there's a very interesting question in the Q&A, which kind of addresses a little bit of what you just asked, Larry. So from my perspective, if a seller of a business really needs to understand why they're selling. And too often a seller of a business maybe thinks it would be a good idea to sell, and then you get through the process, and sometimes it interferes with the closing when they realize, oh my God, what am I going to do? Or maybe worse, if they realize, oh my God, I'm not keeping much of this because I didn't plan for the tax ramification, or any of those other oh my God reasons. I would give the same advice to buyers in terms of, there's a reason they want to go into business. I know personally, when I had a change of career, Lee, I know it surprises you, I didn't grow up wanting to do this. I was in a change of career, and I was looking for something very specific, and it was Kensington that helped me define what it is I was looking for, because it was all about quality of life. Yes, it was about income, but I was coaching my kids' soccer, so I wanted to have my nights and weekends, and I didn't want to be a slave to the business, and and many other factors. So they have to zero in on why it is they're going into business, and what are they replacing. Are they really looking to replace a $200,000, $300,000 income with a business? Well, that looks very much different than if they're looking to just have something on the side and they're happy to run it semi-absentee, and earn 50, 60, 75,000. Very, very different thing. And so I would tell you that Lee said it as well as anyone could say it. It's all about being prepared. As a seller, understand what you're walking into, get prepared, have the team around you that's going to assist you in that preparation. Hopefully that team is going to be straight with you and set your expectations so that it's not unrealistic, and we don't invest all of this time, to get to a place that does not make sense for you as a seller. And as a buyer, it's a very scary thing as a buyer, to make a change or to invest money that took, a significant amount of time to accumulate, and dip your toes into something that you're not that familiar with. So from the buyer side, you really need to get comfortable with what it is that you're doing and why you're doing it. And, I have it in here and somewhere I'm going to bring it up, so maybe I'll use it now. Your team, the people that you surround yourself with, they're really your linebackers, or your line. They're your offensive line. There will be body blows. If you're a seller, that buyer is going to take you to task in due diligence. You've got to be prepared to respond to that. So this is when you use people like me, people like Lee. So you stay above the fray, make them aware of the minefields or the challenges so they have an appropriate response and can keep the ball moving down the court. That's my recommendation on the selling side, and equally on the buyer side. Be prepared. Know what you can buy. Much like a house, you go out for a mortgage, they tell you get pre-qualified. Much more difficult on a business, but you have a good sense of things. You know how much you could put down for a down payment. Have those discussions with the banker. Understand what you might qualify for in terms of buying a business. But let's recognize that so much of the loan for a business acquisition really falls on the strength of the business.
So we are getting a few questions. So let me address a few of them. So what percentage is given to the effect of COVID on the business when it's not reflected in the financials?
Lee, you want to take that, or you want me to take that?
I'll let you take a stab at that one, but I think that's varies case by case.
It absolutely varies case by case, but to get a general sense of things, and if I understand the question correctly, what I'm finding is that if a business came through COVID and was off by 10, 20% in their revenues because of COVID, and now they're coming back, that business gets a buy. That business survived, that business did well. Most buyers are giving that business a pass, and they'll value that business based on 2019 and 2021 projections. If the business is off by 50, 60% and hasn't pivoted and hasn't come back, we've got a challenge ahead of us. I hope I answered that question.
So another question here, it talks about financials and someone looking to buy a route and has gotten some good financials for 2020, but thinks 2020 may be an odd year. Should I request 18 and 19?
Yeah, I saw that question, Larry, and really quite simply, you want to get as much information as you can. And certainly I'm sure Albert would agree. Relying on 1 year's financials, COVID or not, is not something you want to do. The typical evaluation is a 3-year look back. So I would certainly say that in any instance, a route or any type of business, you want to get as much financial information as you can, and at a minimum 3 years.
So what financial documents should they be requesting?
Tax return, because theoretically they're accurate, as well as an accountant prepared balance sheet and profit and loss statement. And that would be for each year. And that should give you a pretty good indication. Again, it's one of those things that you can take them at face value once you get further into the process. And typically, when we do a transaction, especially a larger one, there's a due diligence period that takes place after going to contract. And that period of time can vary. Usually it's a minimum of 30 days, but it could extend depending upon the size of the business. Really, you want to have your financial experts go in there and do an evaluation of the numbers to make sure they appear to be correct. That's not my expertise. Albert may be able to speak a little bit more about that.
So it's absolutely accurate. Is it a V6 or a V8 engine? Those are the P&Ls and balance sheets, and maybe the tax returns. But let me add to what you said and just speak about the off-balance sheet items. So many businesses are so different and complex that oftentimes the business doesn't sell on the strength of the financials. Sometimes the financials really aren't even important. Who the clients are, what vertical are you in, what does the management look like, what are they not doing well that you could do well as a buyer? And social media is one great example that many businesses who that are baby boomers don't do that quite so well. And again, I'm generalizing, so I don't mean to offend anyone. But maybe someone in their 20s or 30s can do a better job at. So while Lee is absolutely right, it starts with the financials. Doesn't end there when you're looking at a business. What are the reasons you're buying? Because if I'm a manufacturer of bolts and I want to go buy a screw company, and I know that I have infrastructure and I have warehousing and I have personnel and I could very easily absorb that company in there, I'm going to go look at their clients. I'm going to look at where their business comes from. I'm going to look at their brand name, and I'm going to see if I can take that company and put them together and have one and one make three. So it is the financials, but it's also all of the off-balance sheet items that one has to look at.
Well, I think also to point out is that there's also a adjustment to those balance sheets that's commonly done because of add backs. Especially when you're dealing with a smaller business, you have add backs. As a principal of a business, they could be paying themselves a lot of money or a little bit of money. So you want to normalize that and say, okay, if somebody was acting as the CEO of the company, what would their salary be? There's also a lot of personal expenses that people pay out of the business, and certainly those get added back. So it's traditionally officers' salaries, perks, benefits, and sometimes automobiles, health insurance. I'm trying to think. Anything else you can think of, Albert, that often gets added back to do an adjusted? You've seen it all.
I've seen education. I've seen sports cars. I mean, business owners.
A lot of entertainment. Now you can't deduct
Right.
sporting tickets and season tickets. So a little bit that's been curbed.
Right. So really the skill there is adding back the appropriate items, not the inappropriate items. If a seller is the be all and end all of the business, and they're the salesperson, they're the operations manager, they do everything, is it fair to add that salary back? You're going to have to replace that guy. So being fair about the add backs and being logical about the add backs, but definitely add backs are a consideration, and the only ones that you kind of did leave out are exactly EBITDA, right? Interest, depreciation, amortization, those kinds of things can be added back because the buyer wants to get a good picture of the available cash flow. And it's my job to show that to a buyer.
Right.
What does it look like for them?
And I think the important thing to note is this isn't something people should be doing on their own. They need someone like yourself or their accountant to help them, go through the numbers and analyze them and, figure out whether or not the asking price is an appropriate one and what value they think they can derive.
Yeah, and that's really on that point, Lee, where I would tell you, I get along pretty well with attorneys. I get along pretty well with accountants. I mean, I like them, they like me. But every once in a while, I'll get, well, my accountant says I could sell this for, 5 times revenue. That's what he says. Great. Let's go have your accountant go try to sell that business. So you have to have a market-oriented approach. You have to know what you're dealing with. Like you said, the automotive market is going to be very, very different than other kinds of markets in valuation and how you look at the financials. So it needs a team. It needs, me, you, Larry, and the rest of the team that surround that business owner. And we need to be realistic and honest with them.
Yes.
Great. Let's switch gears a little bit. Let's talk about it from a seller's point of view. A seller's going to decides to sell, and they're nervous about releasing certain information. So how can a seller protect their confidential information and trade secrets when they're trying to sell their business?
Well, I generally recommend that a seller have a form of non-disclosure agreement, and before they start providing any information to a prospective buyer, that form be signed. And that obviously provides for protection of the information from disclosure, but more importantly, use of that information, so that if the deal doesn't go through, you want to make sure that whether they're a competitor or just somebody new into the industry, they're not going to use your confidential information to compete against you or for any other purpose. But I would also suggest that, again, depending upon the complexity of the transaction or the business that you're trying to sell, that you also be careful with respect to what information you're disclosing and at what time. Until you know you really have a viable buyer, you may want to hold off and withhold some information and not be, so free of giving it out. A asset purchase agreement typically would include confidentiality provisions as well. They're much stronger. There's also a deposit on the line. So you're dealing with somebody who's actually a real buyer, as opposed to someone who's just kicking tires. I kind of view the process before a contract in like a real estate transaction where, you have an open house. When the business is up for sale and people are, inquiring, they're going to want to see financials because they're going to want to get an idea of whether or not it's something for them. But I think you want to really limit it to, very basic information until you know for sure that they're interested, and then you can certainly disclose more. I think also one of the things I would also typically do, and sometimes it's in the non-disclosure, sometimes I wait for the purchase agreement, is I want to make sure that if I'm introducing them to my employees, they can't try and hire my employees if the deal goes sour or they don't even make an offer. It's not something that's never happened, where someone looks at a business, decides they don't want to buy the business, but they are dealing with the manager of the business who they say, wow, this guy's a great person. And they try and hire him away. So you want to try and prevent them for a period of time from doing that. And you also want to, as I said before, be careful with respect to what information you're disclosing and how in depth you're willing to allow them to go. Unfortunately, again, depending upon the business, a customer list is a very valuable asset. And very often, in certain businesses, I won't allow a client to release the customer list until we actually close. Because if for some reason we don't close and the person has put down a deposit, if they have their customer list, we're in big trouble. So again, you have to deal with it on a case-by-case basis, but the value in a lot of businesses is in its confidential information. So be very weary and try and have as many as strong an agreement in place as possible. But keep in mind that agreement just puts you into a lawsuit and gives you a claim. But your business could suffer as a result of improper use of that information.
Yeah, and I want to add to that, Larry. This is the notion. Lee said it very, very well. It's we're the blockers. We're the front lines. You have to release a little bit of information to interest the client, but just enough to find out if this makes sense. It makes sense to proceed, and if it makes sense to peel that onion to the next layer. In general, the employees and the customers are at the end of the process, because it's so dangerous to allow a buyer that level of access. So we really do protect the client. You have to, because you don't want them and their business getting hurt because of this process.
Yeah, I think that's pretty accurate.
Great. We have one more poll that we're going to do. I know there's a lot of questions, so we'll get to them now. And if not, we'll get to them at the end of the webinar. I'll leave enough time to make sure we can try to get to all of them. But the last year has definitely everyone's faced a lot of challenges. And we want to know what was the biggest challenge you faced last year? We have a few different answers. I'm going to launch the poll now. I'm going to leave that open. Let me get to one of these other questions that that we have here. Someone wants to know, Nan wants to know, if you're selling to someone, an employee, and you're going to hold the note, are there big tax ramifications at the time of selling or when the loan is paid off?
Lee, you want to start with that?
Sure. I think that's a tax question, and I'm going to qualify my answer by saying I am not a tax professional or an accountant. But generally speaking, the money received is taxable as it's received. So whether you're selling to an employee or you're selling to a third party, it works the same way. So things can be structured so that you can defer the taxes if you're being paid out over time. If you're being paid in a lump sum, then you recognize the tax right away.
Right, and so I agree with Lee that where you get your CPA involved and understand that, and one needs to understand that as a seller. But what I would add to that is my biggest concern on the note is not the tax that I might pay on it. It's going to be, am I getting paid?
Yes.
Does this employee have the wherewithal to sustain my business so that I can realize my gains from that note? How am I securing that note? What kind of personal assets does the manager have that I might be able to lean on? And I know Lee would tie them up, left, right, up and down to make sure that that note was as best as possible secure so that they can get their money.
Yeah, and we also want to try and, if there's a default, put the seller back in control of the business. So sometimes we also structure it so that it's a stock sale as opposed to an asset sale, and they purchase a portion over time as opposed to buying the whole business, and now you're out of the business.
Correct.
So there's many different ways of tackling that to try and protect the seller. And quite frankly, as in every transaction, one of the biggest concerns is making sure you get paid. And although you may have comfort level with respect to your employees, you want to make sure that they have skin in the game.
Great. So we have a question. Someone wants to know, are there companies, and if they are, which companies will provide loans for first-time business buyers?
I
think we call those banks.
Yeah, we call those banks. We call them SBA, government. And there are also many different kinds of agents that, while they work with the SBA, what they really do is they help people tap into their 401ks and their retirement savings in such a way as to not create a taxable event, so they could use those savings to enable them to purchase businesses. So if anybody really wants to get into the nuts and bolts of that, this is why we put our information in the chat. We're happy to hear from you.
Great. I'm going to share the results from our poll, and it looks like that the biggest challenges have
employees.
been employee related, and followed by the customer
Yeah,
related.
I'm not surprised by that. My firm also does employment law, and for 3-4 months, particularly in the beginning of COVID, my partner was on the phone almost 24 hours a day, coaching clients through different employee issues that were arising in connection with COVID and COVID related issues.
Great. Thanks for participating. So Lee, I've heard that a sale can be structured differently, either as a stock sale or an asset sale. Can you describe the difference between the two and both the advantages and disadvantages of each?
Sure. An asset sale and stock sale are just like they sound. You can buy the assets of the business, which means you're actually setting up your own company, and that company is going to buy the equipment, the vehicles, take assignment of the lease, and whatever other assets are being purchased, you will acquire them for an agreed upon price. In comparison, a stock sale is if I own ABC Corp and it's running a business, and I'm the buyer, I'm coming in and I'm actually buying the stock of ABC Corp. So I'm paying whatever money I'm paying, and I'm receiving all the interest in that company. So they're two very different types of transaction with the same results of acquiring a business. but they do have different implications. For a stock sale, the advantages for a seller are sometimes there are often favorable tax treatment of the sale proceeds. It's kind of a complicated analysis, but I'm not going to get into today, but there are some tax advantages to structuring it that way as a seller. Also, if it's a stock sale as a seller, you're not retaining any of the liabilities because you're basically walking away from the company and now somebody else is stepping into your shoes. So any liabilities of your company are now being assumed by the buyer. Now, as a buyer, that's not such a great thing. And that actually requires much more extensive due diligence, as well as often indemnification, which is a fancy word for reimbursement if any claims come up relating to the operation of the business prior to the sale. And often there's money held in escrow to ensure that there are no claims against the business for which the buyer is going to be responsible. A stock sale is actually a little bit of an easier transaction, but it's less frequently done. Only in certain industries and types of businesses do you find that people regularly do stock sales. I think that very often it comes down to if there are customer contracts that are difficult to assign. It's easier for someone to come in and just buy the stock as opposed to the assets of the business. An asset sale, the advantages are a seller can actually retain certain assets. As I talked about before, in deciding what assets to include in a sale, you keep the cash that you have on hand typically. Often you keep your accounts receivable, and you will also potentially keep security deposits, prepaid expenses, and things of that nature. So as a seller, there are certain advantages, but the tax advantages of the stock sale generally outweigh those advantages. I would say that 85% of the transactions that I work on are all asset sales. And those are much better for the buyer because they're walking into this business with a fresh company, and generally minimal liabilities other than the ones they're aware of, and specifically assuming that they're going to be taking responsibility for. And as I said before, the buyer, a seller is most concerned about getting paid. A buyer is most concerned about what liabilities are going to stick to them once they buy this business.
Great. Thanks, Lee. We have a couple other questions. Albert, there's a question for you. I think you addressed it a little bit earlier. Do you see this more of a seller's or a buyer's market post-COVID? So why don't you cover that? And then why don't you also cover some of maybe the red flags and mistakes to avoid both buying and selling?
Yeah, I have an interesting take on this because, I often, if you want to live in Jericho, not to pick on Jericho, you're going to pay a premium to go live in Jericho. If you can't stomach the notion of paying the premium to live in Jericho, you're not going to go live in Jericho. You're going to go make another decision. Buyers have a vision of what they want and what they'll pay for. And generally, if you're buying a premium business because that's what you want and that's what you see, you'll pay a little bit more for that business than you will if it's a business that's got, a lot of hair on it that you have to make a lot of changes. So that being said, I believe it's both. And this is what just fascinates me about this market. As a buyer, I can borrow better and it costs me less, so I can buy those better businesses and I can pay a little bit more for them. And there's plenty of them around, and you can choose, and this is what's unique about our company, you can choose a business that has existing cash flow, that's in manufacturing, distribution, services, or you can go down the franchise route. You can buy a franchise resale, or you can start something up on your own. The point is that there's plenty to choose from, and our job is to figure out what makes sense for you as a buyer, and that's what we help you do, and we do that at no charge. As a seller, this is a phenomenal time because I mentioned that reset button. It really seems to me that people took the opportunity in COVID to think about what it is they wanted in life, and they're going for it. I'm seeing more buyers in the market vying for those better businesses. So if I'm a seller, I'm very happy right now. And that's why I'm telling you it's both. It really is both at this moment in time. In terms of mistakes, I love this one. I have a presentation that I do that takes about an hour on its own, and 20 minutes of that presentation is a slide I have with the 12 biggest mistakes that sellers make. But for the purposes of this and keeping it short, but I will send out to anybody that asks for my 12 mistakes. I'm glad to share them with it. Number one, Lee mentioned it. It's not being prepared. If you're not prepared as a seller, you end up missing the opportunity. And being prepared means not understanding the process, not being prepared on the financial side, not having the right team, not being mentally prepared. So being prepared without a doubt is the key. My number two is unrealistic expectations. Well, my friend sold his business for yada, yada, yada. The market will pay what the market will pay. I mean, those stories, those unicorns that you read about, those one-offs, Uber raising a $50 billion fund, it doesn't happen in the real world, in our world. So having realistic expectations, and I define that a little bit differently. I try to encourage my sellers to understand that every buyer is different, and every due diligence checklist and every set of questions is different. And being prepared and having understanding that you have to understand things from the perspective of the buyer as well. So I pull that into unrealistic expectation. My number three, I mentioned it for sellers, is not using the linemen, not using that front line of the team that they assembled, trying to take it into your own hands, developing a beautiful relationships, and then boom, they hit the pothole and the whole thing blows up. You have these people around you for a reason. You need to use them. Use Lee, use me, use you, Larry. Very important. On the buyer side, my number one is still the same. It's not being prepared. You need to understand your goals, understand what you're looking for and why, and understand what you can attain. That helps because there's so much opportunity. You can drown in inertia by not being able to know how to move. There's so much to look at. Also, unrealistic expectations on the buyer side. If I'm looking to replace a $200,000 income, how in the world am I doing that with $50,000 investment? That if I'm only have that $50,000, then that takes time, and I have to build that business to get to a $200,000 income. So unrealistic expectations of what things really do sell for versus what they earn. And lastly, on the buyer side, I'm going to say personalities. More than lawyers, personalities kill deals. Sorry, Lee, I have to give you a little one. If a buyer sees a good business, and ego plays such a big role in this, I could do much better with that business than that seller. But if it really is a good business and it's something that you want to acquire, my counsel is to check your ego at the door. Focus on the goal. The goal is acquiring that business. Do whatever you want when you're in. But, you have to make nice to the seller. The seller is going to share all of those trade secrets and put you in a good position for success. So those are my mistakes for sellers and buyers.
If I could just jump in with one comment I had made earlier with regard to hiring the right professionals, and certainly in the context of legal help, you want to make sure it's someone who is used to doing these types of transactions. I kind of build myself as a deal maker, not a deal breaker. But I get involved in transactions where I have litigators on the other side, and all they want to do is fight. We try and get deals done. We try and minimize the risks for our clients, but ultimately, there are going to be some risks. The client's going to decide whether or not they're willing to take those risks. But you deal with some attorneys that they want to eliminate all risks, and unfortunately, I see too many of those deals fall by the wayside. So
So-
you do
Great.
want
So
to be
guys,
careful with
we have
respect.
about 5 minutes left because I want to keep to the hour that we talked about.
Sure.
But I want to try to get to some of these other questions. So there's one question here. I've got some clients that always ask me and they talk about what is their company worth if they want to sell it. And you hear out there multiples of EBITDA. So somebody wants to know what is the right price to sell or buy your business. Is there a rule of thumb? Now I know you're both going to say it depends and there's so many factors, but I thought that would be great. We can answer that question.
Well, I agree. It depends. Every industry, certain industries have certain multiples. Albert can probably opine better on this, but it depends.
Yeah, there really is no rule of thumb. It's a question of what the market will bear. But if you want to really boil it down to why some businesses do better in the valuation side than other businesses, it really does boil down to the predictability of the revenue and the predictability that the revenue will continue. In other words, if I am an alarm company and I sell monitoring services, and every month that bill goes out for monitoring services, the buyer of that business, it's very likely that that revenue stream will continue. They know exactly where the revenue is coming in from. That business will do much, much better than, say, a business like mine, where I don't know what the market's going to do tomorrow. So nobody's going to pay me for my future revenue because we have no predictability of what will ultimately happen. And then, maybe I using an intermediary is a bad example, but, take other businesses,
I
you
think
sell
even
a
like a
product,
restaurant,
a
restaurant
restaurant, a
goes up and down.
distributor, there's no contract. You don't know for sure that the buyer is going to continue to buy or that that patron is going to continue to eat. But in terms of a return on investment, general, okay, don't hold me to this, audience. I'm going to invest $100,000. My internal clock kind of says I need to make that money back within 2 to 3 years. And that is kind of where that 3 times, 2 times, 4 times multiple number comes from. It comes from the internal clock of how long is it going to take me to recoup my investment.
Great.
That's how buyers should look at it.
All right. So we only have a couple minutes left. So Albert and Lee, any final thoughts for our audience out there?
Go ahead, Lee.
I would say, again, go in with your eyes open. Most issues that I run into with my clients, whether they're buying or selling, relates to due diligence. And the more you know going in, the more you're prepared for it when you're operating, when you're selling, whatever the case may be. Don't rush things.
Yeah, and I would add to that there is nothing simple about anything we spoke about here today. All of these issues are complicated, and beyond that, they're personal. Everybody's issues are differently, whether you're a seller or a buyer. You have your own set of circumstances that have to be handled in that way. So we encourage you to be in touch with us privately so that we can address those specific issues.
Great. Yeah, so to follow up on that, we did put all of our contact information in the chats. And if we didn't get to any of your questions, feel free to reach out to any of us directly. I'll forward all the questions to the panels for the ones that we didn't get to see if they can reach out to you directly. So I do want to thank everyone for attending today's meeting. Albert, Lee, thank you. It's been a lot of great information for everyone who attended. And thank you everyone again, and have a great day.
Thank you. Thank you for hosting, Larry.
And thank you, everybody, for coming. And thank you, Larry.